But what happened next has analysts whispering, not reporting. $80, 80, then crash. Vanished in hours. No explanation, no logic, just a mysterious brick wall, as if someone wanted it stopped. All the metals dropped. But silver? Silver screamed up, then was silenced. China's still buying. Trump just made a move in Venezuela. Banks are nervous. And something is building behind the charts. The kind of move that doesn't come back with a warning. Stay with us, because what we're about to reveal changes everything you thought you knew about silver. And it may already be too late. Welcome to CSC Alert. If you're over 50, this isn't just a YouTube video, it's a wake-up call. Hit that subscribe button like your retirement depends on it, because it just might. And let us know in the comments, where are you watching from today? They did not expect silver to behave this way, not overnight, not this fast, and not with such precision. When markets reopened, the numbers told a story that did not fit the usual pattern. Silver had surged to around $82.80 during thin overnight trading. Then, almost without warning, it was driven sharply lower, falling to the mid-70s within hours. The size of the move was large, the speed of the move was unusual, and the timing raised serious questions. For experienced observers, overnight trading is normally quiet, liquidity is thinner, volume is lower, and prices usually move in smaller ranges. That is why what happened stood out immediately. A move of more than $6 in such a short window is not common. It demands attention, not excitement. This is not about drama, it is about structure. They began by looking at the broader picture. It was not only silver that fell. Gold dropped sharply, platinum and palladium were hit even harder. Rhodium also declined, though it remained at historically high levels. At first glance, this looked like a broad precious metals pullback. Many commentators quickly reached for familiar explanations: profit-taking, technical resistance, overbought conditions. These explanations sound reasonable, and sometimes they are correct. But in this case, they did not fully explain the behavior of silver. Silver is different from the other metals. It sits at the intersection of finance, industry, and geopolitics. It trades like money in moments of stress, and like an industrial input when growth matters. Because of this, silver often moves with more force and more volatility. Even so, volatility has patterns. This move broke them. They looked at the chart more closely. The price did not drift lower. It hit a clear ceiling near the highs and stopped almost perfectly. It was as if it had struck an invisible wall. For a period of time, price flattened at that level. Then, heavy selling appeared. Not gradual selling, not cautious selling. Large, decisive volume that pushed the price down quickly. This behavior raised a serious question. Was this a natural market reaction, or was it a controlled response? To understand why this matters, one must understand how price discovery is supposed to work. In a healthy market, prices rise when buyers are more aggressive than sellers. They fall when sellers overwhelm buyers. Resistance levels usually form over time, where many participants agree on value. But this level appeared suddenly in low liquidity conditions and held with unusual precision. Some analysts described it as a brick wall. The term is informal, but the idea is clear. The market behaved as if a limit had been imposed. This does not prove intent. It does not prove manipulation. But it does justify skepticism. They also noted the timing of the selling. A large portion of the volume appeared as U.S. markets began to open. This is important. The opening hours often bring institutional activity. Large funds adjust positions. Banks manage risk. Algorithms respond to price levels and volatility thresholds. When heavy selling appears exactly at these moments, it suggests structured behavior, not random emotion. At the same time, there were strong forces that should have supported silver. Central banks, especially in Asia, continue to accumulate gold. This matters because gold and silver are linked through capital flows and investor psychology. When gold demand is strong, silver usually benefits over time. In addition, geopolitical tension has not eased. If anything, it has increased. They considered recent developments. The United States made a decisive move regarding Venezuelan oil. This action reshaped energy flows and reduced China's access to a key supply. At the same time, tensions around Iran continued to rise. These events matter because commodities are strategic assets. When global power balances shift, commodity markets react. Yet, despite all of this, silver was pushed down aggressively. This led to another observation. Gold fell, but not as violently as silver. This difference is important. Gold is held primarily by central banks and long-term institutions. Silver has more exposure to futures markets and short-term trading. That makes silver more vulnerable to forced selling when volatility rises. Here is where the warning begins. When prices move this fast, leverage becomes dangerous. Futures traders who are overextended are forced to sell. Margin requirements rise. Positions are closed, not by choice, but by necessity. This kind of selling has nothing to do with fundamentals. It is mechanical. And mechanical selling can temporarily overwhelm real demand. For business leaders and serious investors, this distinction is critical. Short-term price drops can hide long-term signals. Volatility can be used to shake confidence, flush weak positions, and reset market structure. This does not mean silver's role is diminished. It means the opposite. It suggests the metal is important enough to require control during sensitive moments. They watched the rebound carefully. After hitting the lows, silver began to recover, not explosively, but steadily. This suggested that buyers were still present. They had not disappeared. They were waiting. Was this simply a volatile correction in a heated market? Or was it a deliberate effort to slow momentum at a critical threshold? The answer does not lie in headlines. It lies in structure, timing, and behavior. He had seen price ceilings before, technical resistance levels, round numbers, psychological zones. But this was different. What happened at 82 to 80 wasn't T resistance formed over days of trading. It was resistance that appeared like a sudden stop sign, out of nowhere. The silver market didn't pause, it froze. For a few tense hours in low volume overnight trading, the price hovered just below the $80 mark, as if waiting for permission to break higher. But that permission never came. Instead, volume disappeared, bid-ask spreads widened, and then, without warning, a heavy block of selling pushed silver down violently. This is what analysts and veteran traders are calling the brick wall effect. It's not a technical term from textbooks. It has a description born from observation, when price runs into a level where no further movement is allowed, despite positive momentum. It's not just a lack of buyers, it's as if an invisible hand is pressing the price down. And that raises questions. Who is behind it, and why now? To find answers, they turn to market microstructure. That's the study of how trades actually happen. Order books, volume imbalances, liquidity gaps, and algorithmic behavior. At the heart of the brick wall thesis is one possibility: strategic resistance imposed by large players trying to manage exposure. In simpler terms, someone didn't want silver going any higher. Let's examine the scenario. When silver touched $80.80, the momentum was positive. The Shanghai price was already trading higher. Industrial demand had been growing. ETFs had seen inflows, and geopolitical tensions were creating a safe haven bid. Fundamentally, there was no reason to expect a sudden reversal, unless someone was positioned poorly. Enter the banks. Several large commercial banks carry net short positions in the silver futures market. These positions are public via Commitment of Traders, COT reports. A rising silver price means rising losses for those holding shorts. But if the price can be capped, even temporarily, it gives those players time to reposition, hedge, or unwind. This is where market tools come into play. High-frequency trading algorithms can place layered sell orders just below key price thresholds. These orders don't need to be executed. They just need to appear, signaling resistance and weakening momentum. At the same time, a few real sell orders at strategic volume levels can trigger stop-loss orders placed by retail traders or momentum algorithms. Once that chain reaction begins, the price collapses under its own weight. This doesn't require conspiracy. It requires coordination between risk desks and algorithms programmed to defend certain thresholds. These defenses are not always visible. But when a price hits a level, stalls, and then collapses without fundamental change, analysts start asking if the market was allowed to breathe. Observers also noted a lack of follow-through from institutional buyers. If the fundamentals were strong, why didn't the smart money step in and absorb the selling? The answer may lie in the structure of the futures market. Unlike physical silver, which requires custody and capital, futures allow massive exposure with minimal margin. This leverage is a double-edged sword. It accelerates gains, but also exposes traders to sudden liquidation. And when volatility spikes, brokers raise margin requirements. That forces traders to sell positions just to maintain capital ratios. These events cascade, not because of fear, but because of risk protocols. It's not manipulation in the classic sense. It's a system response to leverage and liquidity stress. But the effect is the same. A powerful upward move is stopped cold and reversed violently. From a strategic standpoint, the timing matters even more. This happened during a low liquidity overnight window, a time when price is easiest to move with the least capital. The initial surge occurred when Asia was active, and the reversal began just as U.S. markets prepared to open. This is a well-known pattern. Use low volume hours to test resistance, then use the open to release the pressure valve. It's coordinated, not chaotic. Veteran traders describe this as painting the tape. The goal is not to create a long-term trend, it's to manage perception. Make the chart look weak, trigger technical signals, and cool off speculative momentum. The reward? Time. Time to settle shorts. Time to let volatility burn out. Time to shake retail confidence. And yet, despite all this, silver bounced. After hitting $76.31, the price clawed its way back above $78. That recovery wasn't dramatic, but it was meaningful. It showed that real demand still exists, and that the underlying forces pushing silver higher haven't gone away. The brick wall may have worked once, but walls don't last forever in commodity markets under pressure. This brings the story to its key insight. When markets show unnatural resistance, it's not a sign of strength, it's a sign of defense. It means someone is trying to slow things down, not because they're in control, but because they're vulnerable. For entrepreneurs, capital allocators, and strategic thinkers, and this is the lesson, don't watch just the price. Watch the structure, watch the timing, watch what's not being said in the headlines. Because when a wall appears in silence, it's not built for strength. It's built for delay. The narrative expands outward. We will explore the geopolitical moves, specifically China's gold strategy and the U.S. action in Venezuela, that may be influencing silver behind the scenes, not through headlines, but through consequence. While traders were fixated on price charts and technical resistance, something far more significant was unfolding in the background. Beneath the surface of this violent silver move, beyond the brick wall, beyond the algorithmic selling, lay the unmistakable fingerprints of global power realignment. The silver market did not move in isolation. It responded, as it always does, to signals sent from the highest levels of statecraft. The turning point came quietly. A late-night announcement from the United States revealed that Venezuela would transfer up to 50 million barrels of oil to the U.S., following the capture and removal of Nicolás Maduro. Valued at nearly $2.8 billion, the oil would be sold with proceeds benefiting both countries, according to the statement. The phrasing was clinical. The implications were not. This move wasn't simply about energy. It was about control. For years, China had been Venezuela's largest oil customer, using it as a strategic foothold in Latin America to counter U.S. influence in the Western Hemisphere. This new deal abruptly severed that line. It repositioned Venezuelan oil within U.S. reach and under U.S. military protection. It was more than a diplomatic win. It was an economic reoccupation of a key resource node. This mattered for silver. Why? Because the silver market is no longer driven solely by industrial output and investment flows. It is increasingly shaped by geopolitical commodity strategies. And in this new framework, Venezuela's oil, and the U.S. reclaiming it, alters the flow of capital, the alignment of allies, and the global perception of resource dominance. But the ripple effects went further. Almost simultaneously, analysts noted a continuation of China's aggressive gold accumulation. For 14 consecutive months, the People-RS Bank of China had added to its reserves another 30,000 troy ounces in the most recent tally, bringing the total to more than 1.35 million ounces acquired since November 2024. This isn't about jewelry or sentiment. It's a state-level shift toward real assets. China isn't buying gold for decoration. It's insulating itself from currency risk, trade weaponization, and system shocks. And here lies the silver connection. In Chinese monetary tradition, gold is held by the state, a symbol of sovereign strength. But silver is held by the people. Historically, silver served as a transactional currency in China for centuries. Today, it plays a dual role. It is both an industrial necessity and a psychological fallback. When the People's Bank of China strengthens its gold position, it signals confidence in hard money. When the Chinese public watches that move, they often respond by increasing their own holdings, mostly in silver. This coordinated shift is important. It's not speculative, it's strategic. It's worth noting that the silver premium in China has consistently remained above the COMEX price. That signals one thing: physical demand is strong in the East, while the West plays paper games. The divergence reflects not just a price imbalance, but a philosophy gap. One side treats silver as optional, the other treats it as essential. Returning to Venezuela, the U.S. action there also had secondary effects. By establishing control over Venezuelan oil exports, the U.S. signaled a broader return to the Monroe Doctrine mindset, a policy of asserting hemispheric dominance and denying access to foreign powers, especially China and Russia. But this wasn't just about fossil fuels. Many forget that Venezuela also has undeveloped silver reserves. By regaining influence over the country's exports, the U.S. has also created a future supply-side pivot for critical metals. At the same time, the U.S. strengthened its dollar. The Venezuelan oil deal, the increased military presence in Latin America, and growing tensions in Iran all helped push the DXY dollar index higher, reaching 98.72. A stronger dollar typically suppresses commodity prices, at least on paper. But the paper price and the physical market are beginning to disconnect. Silver is the pressure point where these tensions become visible. If China continues acquiring gold, if the U.S. continues intervening in commodity-producing regions, and if the East continues paying a premium for real metal while the West suppresses it via futures, then the silver market is not simply a chart. It is a proxy war. In Iran, protests erupted again. 2 cities reportedly fell into civilian control. Theocratic leadership is under pressure. Iranian state media condemned the U.S. removal of Maduro, citing it as a model for regime change tactics. Behind the public condemnation is private concern. Could Iran be next? This regional instability fuels global uncertainty. And silver, cheap, small, and portable, becomes the asset of choice in regions expecting monetary or political disruption. Meanwhile, Trump's messaging has grown clearer. He isn't hiding intentions, he's broadcasting them. The U.S. will control key commodities. The U.S. will enforce supply chains. And the U.S. will dictate who gets access and who does not. This kind of clarity doesn't calm markets, it divides them. And here is where the strategic insight emerges. China is preparing for a multipolar world built on real assets. The U.S. is reclaiming regional resource control and using military tools to do so. Europe is watching from the sidelines, largely reactive. And the silver market? It sits in the middle, reflecting real demand, but still priced by fragile structures. The price spike and collapse wasn't only about profit-taking. It happened against the backdrop of global maneuvering. When silver surged, it wasn't just a technical breakout. It may have been a signal flare of growing structural stress. What happens when more nations bid for physical metal? What happens when one country controls oil and the other controls solar panel production? What happens when trust in settlement breaks down? These questions don't belong on YouTube thumbnails. They belong in boardrooms. We will move from geopolitics to system mechanics, unpacking the dangerous divergence between paper contracts and physical delivery, the growing inventory shortage, and what it means for strategic capital preservation. The paper price of silver collapsed, but physical demand never flinched. That is the core paradox now confronting the global silver market. As the overnight spike to 82.80 was crushed back to the mid-70s by heavy futures selling, something remarkable began to unfold beneath the charts. The physical silver market remained tight, resilient, and largely unmoved by the price collapse. This is not just a technical detail. It is the most important structural development in the silver market today. What we are witnessing is the widening of a quiet fracture, a divergence between price signals in the digital futures markets and supply behavior in the real world. At the center of this fracture lies the COMEX. For decades, the COMEX has served as the primary price discovery mechanism for global silver. Futures contracts traded there set the reference price for bullion dealers, industrial users, and even governments. But this structure depends on one core assumption, that paper contracts can ultimately be converted into real metal, even if most never are. That assumption is now breaking down. Over the past several months, dealers have reported increasing delays in silver bar deliveries, premiums have widened, inventories across multiple vaults, including COMEX, LBMA, and even private refiners, have thinned. Silver bars, especially in 1000 Oz formats used by ETFs and industrials, are increasingly difficult to source in large quantities without delay. Meanwhile, the price set by COMEX has become increasingly volatile and increasingly disconnected from the actual difficulty of obtaining physical silver. This divergence is more than market noise. It's a signal of stress within the system. Consider this. Even after the violent overnight drop, premiums on physical silver in Asia and the Middle East remained elevated. In Dubai, large coin dealers continued quoting silver coins at over 100 Oz, despite the official spot price being in the mid-70s. In Shanghai, silver traded at a consistent premium above COMEX with no sign of softening. This is not panic buying. It is structural scarcity. Why does this matter? Because the futures market is a leveraged system. Every silver contract represents 5,000 ounces, but less than 1% of those contracts ever result in physical delivery. Most are closed, rolled over, or cash settled. This structure only works when confidence is high and when delivery is possible. But what happens when delivery becomes uncertain? You get forced price suppression and synthetic disconnection. Paper prices moving in directions that physical markets no longer respect. This isn't theoretical. It has happened before. In 2008, the gold and silver markets experienced a similar divergence. Spot prices fell sharply, but physical products vanished from dealer shelves. Premiums soared. Delivery times extended from days to months, and in the aftermath, many institutions began reassessing their exposure to paper commodities. The difference now? The scale is larger, the exposure is broader, and the demand is permanent. The drivers of this demand are no longer just retail investors or coin collectors. They are solar panel manufacturers who require silver for photovoltaic cells, electric vehicle producers whose growth depends on conductive metals, national mints and refiners who are facing pressure from both retail and institutional clients, central banks and sovereign wealth funds increasingly exploring silver as a second-tier monetary reserve asset. None of these actors sell into price weakness. They accumulate. That is why the paper price is now losing credibility as a signal of value. When silver surged to $82.80, it did so on momentum and macro stress. When it fell back to $76, it did so through paper leverage liquidation, not because physical buyers disappeared. The real demand didn't vanish. The market structure temporarily overpowered the fundamentals. But such events do not last. When the dust settles, physical demand remains. And supply? Supply is becoming harder to replenish. Most silver is not mined as a primary metal. It is a byproduct of copper, lead, and zinc production. That means supply does not respond quickly to price. Even if silver prices double, it will not immediately produce more metal. The lead time for new production is measured in years, not months. And right now, major miners are not investing in new silver-specific projects. That leaves the market vulnerable. For entrepreneurs and strategic investors, this is not just a warning. It is a signal to adjust expectations. In a normal market, volatility can be dismissed as short-term noise. But in a fractured system, volatility becomes predictive. It warns of system failure. What happens if COMEX faces a delivery failure? What if ETF inflows exceed vault capacity? What if Asian markets refuse to sell into Western weakness? These are no longer abstract questions. They are being modeled inside trading desks, hedge funds, and even central banks. The conclusion? Silver is no longer a simple commodity. It is now a litmus test for trust in the entire pricing architecture of the global financial system. As geopolitical uncertainty rises, as industrial demand tightens, and as futures markets wobble under the weight of their own leverage, physical silver becomes the ultimate arbiter. It does not care about profit-taking headlines. It does not follow trend lines. It simply reflects one question. Do you have it, or don't you? And the next time silver runs to $82 or 100, it may not stop at a brick wall. It may punch through, and the system behind it may not be ready. Stay alert, stay informed, because the next move may not be reversible.